Joining me now is Mike Feroli. He's the chief U.S. economist with JPMorgan. Mike, you've pointed this out in your excellent note yesterday. What are your concerns?
Well, the concern, I think you pretty much summed it up pretty well, is that with the unemployment rate very tight, or very low, I should say, and evidence building of a wage price spiral, which will keep upward pressure on inflation for some time, the Fed, with their policy, should want to relieve some of that pressure to slow growth in demand and, for better or worse, actually get the unemployment rate up just a little bit. But as you mentioned, that tends to be hard when the Fed puts the brakes on the economy, I should say. The unemployment rate usually tends to go up a lot. And so that, I think, really is a concern. It's not necessarily a concern for this year, I would say. The Fed is just getting started. They're obviously going to, or seems like they're going to pick up the pace. But I think given the lags in monetary policy and how that acts on the real economy, next year prospects, are looking a little more dicey if the Fed really needs to slam on the brakes here to slow this wage price spiral that does appear to be developing right now.
Yeah, it's a conundrum if you sort of say we've never been able to see an improvement in the unemployment rate without it basically triggering a recession. Is there anything we could do now to keep that from being the case if you look ahead into the middle of next year or whatever markets are signaling?
Yeah, it's a lot easier to say what we should have done maybe in the second half of last year. I think for now, the Fed, I think they're on the right path of trying to catch up to where they should be. And then they're going to have to be very nimble, I think, in seeing signs of a slowdown and then stopping when that happens. That's essentially the closest thing I think we have to a soft landing where the scenario we're talking about played out was in 94, 95. And in that period, Greenspan, who was a very fine reader of the data, he was quick in noticing that the business cycle was rolling over. So I think we're going to have to be, and the Fed's going to have to be really nimble here in deciding when to stop their hikes. But so we'll see. It could be a bit tricky.
And as you point out, in 1984 and in 1994, those soft landing episodes happened when inflation had already been heading lower for years and the unemployment rate was above its natural rate. So here we are in the opposite scenario. The inflation rate has been heading higher in recent months and the unemployment rate is, would you say, below its natural rate?
I think most estimates would say it's below its natural rate. And certainly the evidence we're seeing in wage growth, which has been running well above productivity growth, would suggest that the labor market is very tight. So by a number of measures, and I think you also mentioned job openings relative to number of unemployed people is at all-time highs. So I think however you look at it, it does feel like the unemployment rate is below its natural rate and therefore is exerting upward pressure on inflation. So that is, and again, unlike those earlier episodes, all that you really had to do in those earlier episodes was just slow down growth to around trend growth. Here, the Fed, if they really, are serious about inflation, may have to push growth below trend growth, and that's where you get into concerns about stall speeds, which is a notion that whenever growth gets below a certain level, you tend to stall and actually go into negative growth. So that kind of really compounds the challenge relative to those earlier periods that you mentioned.
And would you be saying, in other words, that the best way for the Fed to avoid a downturn sometime next year would be to be even tighter and even more hawkish right now?
Well, I think that's the rationale behind the Fed's latest pivot toward more aggressive rate hikes in the near term, is to get back to something closer to neutral. Neutral funds rate being something like 2 to 2.5%. Once you get in that range, then it's easier to get policy tight or ease policy if you need be. But I think that's the rationale, is that if you can get there sooner, maybe next year you won't have to be playing even more. So right now the Fed's playing catch up, arguably. And I think the rationale for hurrying now is that you would be playing even more catch up next year if you don't go faster now. So that seems to be what's driving the latest pivot in Fed thinking is, let's get in a better position, not so far off sides as they are arguably right now.